To remain updated with the latest business news, click on the bell icon.
Hello and welcome to Business Today. I'm Siddharth Zarabi, and with me today is Pranjul Bhandari, the Chief Economist at HSBC in India. Thank you very much, Pranjul, for your time with us. Day two of the budget, and we've all had some occasion to go into the fine print. As they say, the devil is always in the detail. I'm going to ask you to begin by telling us your own thoughts and observations about the direction of this budget.
Yeah, great. Thank you. Great to be here. So yes, indeed, we've had like overnight to digest this budget. I think the positive is the fact that there is a clear positive thrust on CapEx, capital expenditure. I think that's a good thing. It has come through. But unfortunately, it has come at a cost. I think the costs are twofold. Number one, social welfare spending has been lower than we had hoped for. And also the fact that now the government is borrowing a lot, which means that there is stress in the bond market, which are pushing up some of the yields. So, this is my overall take. When you put all of this together, the fact that fiscal deficit has been reduced and that generally is sort of anti-growth, but yet CapEx has been increased, which is generally pro-growth. If you combine the two, the net impact on growth, on GDP growth from this budget, in my view, is neutral. It's sort of a neutral budget. Some things are looking great, like higher CapEx, but some other things, for example, social welfare spend, are not looking that good.
Okay, that's a good point, and I heard keywords like anti-growth, but the real point that you make is neutral as far as growth is concerned. Therefore, as a follow-up, does this budget support the recovery, or does it switch directions towards being more conservative after 2 years of some extra spending to beat the pandemic impact on the economy?
I do think that the finance ministry has a strategy at play. I think their strategy is that, look, once you give Narega to somebody, you help out that person for that particular day's consumption, right? But when you give a job to somebody, it's permanent help. I think they have tried to move from temporary help to permanent help by doing CapEx and, trying to get jobs at the back of CapEx. That, I think, has been the general strategy. It looks good to me. But my only problem is that they could have continued for a little longer with, little higher social welfare spending, given the stress we have in the bottom of the pyramid. We are seeing in rural India, demand is slowing. We are seeing, what we call K-shaped recovery. If you track the Narega numbers, demand for Narega works is far outstripping the supply of Narega works. So that does show that there is demand for social welfare schemes at this point. So the government could have continued being generous on that front for a little longer and then eventually gone off to the CapEx bandwagon. So that probably would be my number one browse with the budget.
Pranjul, why has this choice been made at this stage?
Yeah, that's a great question. And then there's a macro backdrop to it. The next 2 quarters, growth is going to be very strong, led by pent-up services demand. Last year we saw pent-up goods demand. By the end of last year, many of us were fully vaccinated. We are more confident to travel now. Once Omicron ends, we will be traveling more. There'll be a lot of pent-up services demand in the system. But the problem is anything that is pent up, has an expiry date because it runs its course. And my worry is, by the middle of FY23, 2 quarters down the line, we'll realize that the pent-up services demand has gone and growth is slowing, and we don't have a growth driver. What's going to lead growth from here? The budget, in some sense, is planning for that. It's planning for the second half of the year. It is trying to set the stage for CapEx, because the hope is that by the time pent-up demand sort of comes off, by then a new investment cycle will rise and become the new driver for growth. I think that was the general thesis of the budget. My only worry with this thesis is that maybe the stage is not fully set for a CapEx rise. I agree with you that public CapEx will increase. The government is trying to increase capital expenditure, but government only makes up 20% of investment. 75 to 80% is actually private sector driven. How is the situation for the private sector? And when you look at that, There are some positives. I think the number one positive is that the balance sheets of corporates are much healthier today than pre-pandemic. They have been able to shed a lot of debt at a time, there was so much liquidity in the system. But unfortunately, just healthy balance sheet is not good enough to drive investment. What they are really waiting for is policy certainty, is macroeconomic certainty. There is just too much uncertainty in the system, wave after wave, commodity prices. So until that settles, I'm not sure private investment will come back in a hurry.
Pranjul, since you speak about this, I'm tempted to ask you: is the government getting any data which is not perhaps publicly available that dictated this strategic choice, as you call it?
Well, look, I don't know how to answer that. As in, I must say that there are a couple of issues here. Number one, we don't have very good data in the informal sector. Even our GDP numbers, they sort of don't really capture what's going on in the informal sector. They just assume that the informal sector is in line with the formal sector, but sometimes that's not true. When you have a huge shock like the pandemic, informal can do worse than the formal. So one thing is that, look, if you go by our official data, then we don't get very good real-time indicators on the informal sector. But what we do get for the informal sector is many other surveys, as in a lot of surveys have come over time. And we're getting more and more surveys every day. And each of them is pointing to the fact that there is distress and there is a lot of problems at the bottom of the pyramid.
Problems at the bottom of the pyramid, and therefore, are you happy with the choice that or the choices that have been made in this budget?
Well, look, as I said, that a capex push, which leads to good permanent jobs in the future, is always good. We want that in our country. But in the meantime, in the very short run, we could have continued with social welfare schemes, at least, increasing outreach on social welfare schemes for a bit longer, given just the amount of stress that we are seeing at the bottom of the pyramid right now. So yes, look, I'm happy that they did capex, but I'm not happy that they cut back so much on social welfare spending. If for all the budget may actually turn out by the end of the year, it may turn out to be quite different. It may turn out that the demand for Narega is so high that the government is sort of forced to spend more on Narega because it is a demand-driven scheme. And because they don't have too much money, they actually cut back from capex. So it may so happen that eventually the capex is a bit lower, but social welfare spending is much higher.
And as you say this, I'm reminded of what happened on the food and fertilizer subsidy account in the current year. Are you also alluding to those risks?
Well, look, looking at the numbers for this year, I'm not sure what you're talking about, but my sense is that they have given enough money for food subsidy, as in they have kept it generous on the food part, but they haven't kept it generous on fertilizer subsidy. And that is sort of my one small little data problem, that they are assuming a 25% year-on-year fall in the fertilizer subsidy bill, which looks rather odd at a time when global fertilizer prices are soaring. So my sense is eventually they'll have to end up spending more on fertilizers while keeping food subsidy elevated.
Given what is happening to oil prices, how do you think that impact is going to play out on the projections for the next fiscal?
Yeah, so look, rising oil prices is a problem across the board for India. It increases our trade deficit, it increases cost of production and therefore lowers GDP growth. It increases inflation. So it's a problem across the board, and that is a problem. That is what we call headwind. That is a headwind we are facing this year, higher oil prices, and that is exactly what makes me a bit worried about growth in the second half of the year. When pent-up demand fades, even the commodity prices are high. Central banks are tightening rates, sucking out liquidity. Then what drives growth in such a situation? And that is my worry generally on growth.
What about the inflation outlook? Is the government more worried about inflation at this stage? This is, after all, a time when there are 7 state elections, 5 of those in March itself. Has that also weighed in on the budgetary calculations?
Look, I think inflation is a problem domestically and globally, and it was also pointed out in the economic survey the day before the budget. So I think the government does definitely know about it. The problem with inflation in India is that I think it's a real problem. Global inflation started rising in 2021. India's inflation was higher even before that, even before 2021, right through 2020. Our inflation numbers have been higher than the RBI's target of 4%. So we really have some problems there. The RBI shifted focus more towards growth and sort of ignored inflation to some extent over the last 2 years. But I think now it has to really move quickly and start ensuring that it does everything to keep inflation contained. Otherwise, things may slip out of hand.
And how would therefore the RBI be going through the fine print of the budget? After all, the governor is a former Secretary of Economic Affairs and has been involved in some budgets himself.
Yeah, I think the RBI always likes high quality spend. So this high capex is something they will like. But having said that, I think the budget has put the RBI in a tight spot. And I'll tell you why. With inflation rising, the RBI was going to tighten monetary policy. It was going to suck out liquidity. It was going to gradually increase rates. It had sort of, planned it out. That's what I understand from, some of the things I listen to their speeches and so on and so forth. They had planned it out. But now what has happened, this budget has come with a huge gross market borrowing. They're going to borrow a lot of money from markets, and debt markets have become very nervous. Bond yields have jumped up. They are very vulnerable. And at this point, RBI will get very scared, because if at this point RBI hikes rates or drains out liquidity, then bond markets may be sort of, doubly hurt. So I think what this budget has done is that it's forced the RBI to delay its policy normalization.
That's a very good point. If it has forced the RBI to delay its policy normalization, I would believe that indirectly North Block has got Mint Street to do what it wants. It hasn't managed to get it to do on crypto, for example, but clearly on fiscal monetary it has achieved it. So as we move ahead, let's do this like a rapid fire round. Hits and misses, starting with the hits according to you.
I think a big positive is fiscal federalism. The fact that they are giving 1 trillion rupees of interest-free loans to states, and the states can choose to spend it in whatever capex they want to do, I think is a very positive part of the budget.
And what about the misses?
The misses is that there has practically been no concern for the bond market. You've pushed a very high borrowing calendar at them. They'll have to buy all these bonds you're now going to issue. And the bond markets were hoping that you take some steps to increase domestic bond inclusion into global indices, something for which talks have been going on for the last several quarters, but no news came on that front.
Okay, as we wind down this conversation, let's take a step back and go through the credibility of the numbers, because you spoke about social sector spending. There have been different comments about the overall rise in expenditure. And there is one view which says in nominal terms, the expenditure GDP ratio is actually declining. Take us through your own assessment about the credibility of the math of the budget, because this is one of the most significant aspects of such an exercise every year.
Exactly, yes. So for FY22, the year that's ending in March 2022, our sense is that the fiscal deficit may come out lower than what the government has projected. Government has projected 6.9% of GDP. It may come out at about 6.6% of GDP. And the reason for that is that they seem to have completely underestimated tax revenues in the Jan to March quarter. So they are assuming tax revenues to grow at minus 15% year on year. And the run rate so far has been a positive 44% year on year. So you just do the math. There can be a lot of savings from there. So that's one. For FY23,
Pranjul, just to interrupt you, that actually puzzles me. You put the numbers very beautifully in context, but as I was kind of seeing snippets as the speech was being rolled out, that is the big puzzle. And one of my instant reactions were that they are sort of under promising, perhaps due to some broader political economy strategy. Frankly, I don't know how to describe it. Is that the sense that you get as
Yeah, so look, this is exactly what they did in last year's budget. They under-promised on revenues and then they over-delivered in a big way. And that went down really positively because it was a huge break from the kind of budgets we used to have, a few years ago where the government used to over-promise and under-deliver. So this strategy worked for them. It sort of made them gain credibility. So I think this is what they have sort of continued with. Even in this budget, to go with the conservative revenue estimates, and then if you're positively surprised, everybody will cheer you.
You were talking about misses when I interrupted you. You want to complete that point?
Yes, so we spoke about FY22, where I said that fiscal deficit may be lower. FY23 broadly looks okay to me. They have been conservative on tax revenues, which I think is a good thing to do right now, given all the problems with growth that we may have later on. The other thing they've done is that they've kept the disinvestment receipts quite low, 650 billion. Which I think is a good thing, because last couple of years they've been keeping it very high, 2 trillion, 1.8 trillion, and they never achieve it, and it's become sort of a laughing part of the budget. So keeping it low and realistic, I think, is a good strategy. So I'm happy with the revenue budget. On the capital, but the expenditure budget, the capex that they've promised, it's a 35% year-on-year increase in capex. It's huge. A lot of people say that the central government has implementation problems. They can't really implement this, but I think it's possible. And the reason it's possible is it's not money that they will be spending on their own. A bulk of that money will be actually given to states to spend. So the implementation challenge will be shared by the central and the state government. So, I'm hoping that there'll be a little more sort of positivity from that front. So I think it's a credible number if there is a push. The only part where I have some small squabbles is that the fertilizer subsidy bill was kept very low. But I think there is space in the budget numbers to take care of that. I think the biggest point is that the budget numbers has a lot of buffers in it. Nominal GDP growth has been projected at a very low 11.1%. Our sense is it will be closer to 12.5%. And that in itself will give them slightly higher tax revenues and help fund some extra expenditure. So a conservative and broadly credible budget math for FY23.
Two quick questions. One on the fiscal glide path that has also been indicated in the budget. Do you think it's workable?
Yeah, so look, this year they did it. So the glide path brings the fiscal deficit down to 4.5% by FY26. Which basically means every single year they need to bring down the fiscal deficit by 0.5% of GDP. So they've done it for FY23. They're bringing it down from 6.9 to 6.4. So that's good. And I think they'll be able to manage it. There's a lot of, as I said, buffers in the fiscal math. But when you have a very high fiscal deficit, which we had in the pandemic, and you bring it down, early days are easy because there's a lot of pandemic measures which can easily be gotten rid of. But the later days become difficult, and my worry is that is going to be a difficult part of the budget. The continuation of consolidation, I think, is going to be a problem in the budget, and the offshoot of that will be that India's public debt is something that could now remain high and sticky for a fairly long time.
That's a good point. It's in other words about how you pace your race. You start off full steam and then run the risk of losing as you reach your goal. My very final question, and a bit of a populist question really, $5 trillion. I've been seeing a lot of social media chatter, different estimates. In the current assumptions, with whatever is expected for exchange rate for the current year, tell our viewers, in your own sense, when is $5 trillion going to happen? Which fiscal year is it likely?
Listen, it'll definitely happen sometime, and that is a great thing about having rolling forecasts. Whenever you say in the next 5 years we are going to get 5 trillion, you can see next 5 years 5 trillion every single year. So that's a great thing about these forecasts. But the truth is, at this point, with 2 years of pandemic behind us, I think nobody is going to be holding the government accountable for 5 trillion. I think maybe once the pandemic is behind us, then we can start thinking about, so what is the more realistic date? But at this point, of course, all the previous expectations of 5 trillion by FY25 is definitely out of the window.
Absolutely. And there are other sort of statements of intent, 6 million jobs in the budget. And I got the sense that there was a bit yesterday in the budget moving from an annual exercise to even a 25 years mention. So both of these statements to me seem to be new introductions. But Pranjul, we've run out of time on this conversation. There must be much more. But as always, it's been brilliant talking to you as you have decoded the budget in the simplest manner possible. Thank you very much for your time and hope to be talking to you sometime soon again. Bye-bye.
If you like the video, do like, comment, share and subscribe.